Hi, everybody. I'm just going to go through an example for the week 4 homework. So let me share my screen so I can show you the examples. Okay, so the first item is the cash register tape for Bob, reported sales of 20,000. Record the journal entry that would be necessary for each of the following situations. In the first situation, sales per cash register tape exceed cash on hand by 30. So that means the cash we have is 19,970 because it's short by $30. We're going to debit cash. We're going to debit cash over and short for 30. We're going to credit sales revenue for 20,000. In the second situation, the cash on hand exceeds cash reported by cash register tape by 20. So in that case, we have cash of 20,020 that we're going to debit. We're going to credit cash over and short for 20 and credit sales revenue for 20,000. Question 3, and I thought this was rather challenging, but Bob is a very profitable small business. It is not, however, given much consideration to internal control. For example, in an attempt to keep clerical and office expenses to a minimum, the company has combined the jobs of cashier and bookkeeper. As a result, Jake Jones handles all cash receipts, keeps the accounting records, and prepares monthly bank reconciliations. The balance per the bank statement on October 31st is 16,980. Outstanding checks, and they list 6 different checks that are outstanding. Included with the statement was a credit memorandum of $510 indicating the collection of a note receivable for Bob Company by the bank on October 25th. This memorandum has not been recorded by Bob. So Bob just wasn't aware of it at the time. They're not aware of it, that the bank collected this money. The company's ledger shows one cash account with a balance of $20,000. The balance included undeposited cash on hand. Because of the lack of internal controls, Jake took for personal use all of the undeposited receipts in excess of $3,000. He then prepared the following bank reconciliation in an effort to conceal his theft. So, first of all, you'll note right away, he's only noting 3 checks. There's 6. Also, if you add this, it's $100 less than what there should be. It should be $590. It's showing as $490. And of course, this isn't reported correctly, that bank reconciliation. So we're going to go ahead and prepare a bank reconciliation, and they do give us a hint to deduct the amount of the theft from the adjusted balance per books. So for the bank reconciliation, we're starting out with the balance per bank, which is $16,980. That's right there. And then what we're going to do is add on to it that 3,000 of undeposited receipts, which are right there. Remember, Jake took the rest of those. So anything over 3,000 he actually took. And that would give us a balance of $19,980. What we're then going to do is we're going to deduct all 6 checks, which are noted here. So we're going to deduct all those checks. We're going to note all the check numbers for the checks, and we're going to total it. When we take the 19,980 and we subtract the 1,060, that's going to give us a balance per bank of 18,920. In the end, our balance per bank and balance per book should equal one another, right? So we have a cash balance per book of 20,000. That's right here. We're going to add on to that bank credit, which we weren't aware of, which is right here. $510 is that bank credit. So we're going to add that onto it. That gives us $20,510. So we now have a problem, right? We have a theft. Well, because of that theft, of course, money was not put into the bank, right? They only show deposited receipts at 3,000, and we have to figure out how much the theft was. To do that, we're going to take this adjusted balance per books. We're going to subtract out the balance per bank. We did that right here. That gives us $1,590. That's the theft amount. So if we subtract the theft amount from that adjusted balance per books, that gives us the adjusted balance per books of $18,920. Again, the reason for this is The bank only got $3,000. They didn't get this $1,590 because Jake stole it. Okay, question 4. On July 1st, Bob Company sold merchandise on account to Jake for $20,000. Terms are 210 net 30. And in your question, you can have different terms. And we're not recording the cost of goods sold in this. We're just recording the sale. So we're going to debit accounts receivable and credit sales revenue for $20,000. On July 8th, Jake returned merchandise with a sales price of $4,000. So we're going to debit sales returns and allowances for $4,000, and we're going to credit accounts receivable for that $4,000. On July 11th, Jake paid the balance due. So it's within the discount period. They're going to get a discount. First of all, remember the accounts receivable is no longer $20,000. $4,000 of the merchandise was returned. So $20,000 minus $4,000 means the credit we're going to have to make to accounts receivable to take it off the books is $16,000. To figure out that cash, it's going to be $16,000 times 98%. 100% minus the 2% discount is 98%. That's $15,680. To determine the sales discount, we're going to take that $16,000 and multiply it by 2% by the discount. So 16,000 times 2% is $320. And then, of course, we credit accounts receivable for the $16,000. Question 5. On January 6th, Bob sells merchandise on account to Jake for $8,000. The terms are 110 net 30. On January 16th, Jake pays the amount due. Again, we're just recording the actual sale. So we're going to debit accounts receivable, credit sales revenue for the $8,000. And then we're going to go ahead and record the collection. So again, you could have different terms in yours, but for this question, the terms are a 1% discount if paid within 10 days. So we're going to take the amount owed for the receivable, $8,000 times 99%, because 100% minus 1% is 99%. 8,000 times 99% is 7,920. We're going to debit cash for that amount. We're going to debit sales discounts for 80. 8,000 times 1%, the amount of the discount is 80. And then we're going to credit the accounts receivable for that full amount owed of 8,000. Question 6. On December 31st, Bob had a credit balance of $20,000 in allowance for doubtful accounts. During 2022, Bob wrote off accounts totaling $12,000. One of those accounts at $2,000 was later collected. At December 31st, an aging schedule indicated that the balance in allowance for doubtful accounts should be $23,000. So this is the allowance method. So first, what we're going to do is, remember, we have to write off accounts. So to write off those accounts, since normally allowance for doubtful accounts would have a credit balance, we're going to go ahead and debit it. So we're going to debit allowance for doubtful accounts for $12,000. We're going to credit accounts receivable for $12,000. And that's basically to get that off the books. Next, we have to reverse that, right? One of those accounts was later collected for $2,000. First, we have to put it back on the books by debiting accounts receivable and crediting allowance for doubtful accounts for $2,000. Then we have to go ahead and debit cash because we collected the money, debit cash for $2,000, credit accounts receivable to get it off the books again. Last thing we have to do is to record the estimated bad debts for the year. So since this is the allowance method, that means at year end, we have to have a $23,000 credit balance, right? Well, we started off with a $20,000 balance. And the way we're going to do this is we've got our $20,000 minus the $12,000 we debited to allowance, plus the $12,000 we credited to the allowance account, plus X equals $23,000. And X is going to be what we have to debit to bad debt expense and credit to allowance to get it to be that balance of $23,000. So we can just set it up algebraically. 20,000 minus 12,000 plus 2,000 plus X equals 23,000. So in algebra, what we would do, I left X on the left side, so we're going to put the other numbers onto the right side. So 23,000 minus 20,000 plus 12,000 minus 2,000 equals 13,000. So we're going to debit bad debt expense, credit allowance for doubtful accounts for 13,000. Question 7. On June 1st of 2021, Bob received a $6,000 12-month 10% note in exchange for an outstanding account receivable for Joe Smith. So we're going to debit notes receivable. We're going to credit accounts receivable for $6,000. We're crediting accounts receivable because that account receivable is no longer owed. Instead, it's been adjusted to a note receivable. And then we're going to accrue interest revenue on the Smith account. So we're going to accrue that interest revenue on December 31st. So if we look at it from June 1st to December 31st, it's 7 months. So the interest revenue and interest receivable, because it's not being paid yet, are going to be $6,000 times that 10% note times 7/12, 7 months, right? June through December, 7 months. And that would give us $350. So we're debiting interest receivable, we're crediting interest revenue for the $350. Next, on December 31st, they tell us they want us to close that interest revenue account. To do that, we're going to debit interest revenue and we're going to credit income summary for the $350. Then in June, we received, on June 1st of the next year, we received the principal plus interest on the note. So we got the actual money. To figure out the cash, it's going to be the $6,000 note plus the interest, which was 10%. So 6,000 times 10% is 600. So if we add the 6,000 and 600 together, we're going to get cash of $6,600. We now need to get that note receivable off our books. We're going to credit it for $6,000. We no longer, that interest receivable right here, that's no longer owed to us, right? So we have to credit interest receivable for $350. We're getting that money now. Nobody owes that to us. Before we had accrued our interest revenue through December of $350. Well, the interest revenue for 12 months would be 6,000 times 10%, which would be 600. Since we already noted 350 of that interest revenue, we're going to note 600 minus 350, 250 of that interest revenue. Question 9. Joan Walsh's regular hourly wage is 20, and she receives an hourly wage of 30 for work in excess of 40 hours. During a January pay period, Joan works 48 hours. Joan's federal income tax withholding is 110. She has no voluntary deductions. FICA tax is 7.65%. So first we have to compute Joan Walsh's gross earnings and then her net pay. So the gross earnings, we have the $20 an hour at 40 hours is $800. $30 an hour for that 8 hours she worked in excess of the 40 hours is $240. If we add the 800 and 240 together, it is $1,040. For the net pay, first of all, we need to figure out the FICA, and we know the FICA tax rate is 7.65%. So 1,040 times 7.65% is $79.56. And then the other item that was withheld was the federal tax withholding, which was $110. So her net pay is going to be that $1,040 minus $79.56 minus $110, which is $850.44. Last question. In January, gross earnings in Bob Company totaled $80,000. All earnings are subject to 7.65% FICA tax, 5.4 state unemployment tax, and a 0.6 federal unemployment tax. So we have to figure out our payroll tax expense and record the entries. So first we need to figure out our payable items, add them up to figure out the payroll tax expense. So we have FICA taxes payable, which are 80,000 times 7.65%, which is 6120. So we're crediting FICA taxes payable for 6120. We have federal unemployment taxes, which are 80,000 times 0.6%, which is 480. We're going to credit federal unemployment taxes payable for 480. And then we have state unemployment taxes, which are 80,000 times 0.54%, which are $4,320. We're going to credit that. If you add these three figures together, 6120 plus 480 plus 4320, you're going to get the 10,920. That is what we are debiting to payroll tax expense. And that is it. So everybody have a great week. If anybody has any questions, please feel free to reach out to me. Bye, everybody.